At 45, Harry had just $50,000 saved and 20 years left to retire. His friends were talking 401ks. He was Googling, "Will I die broke?" Then he found a strategy so simple his teenage daughter understood it. And by 65, he had over $850,000. No stock picking, no timing the market, just one decision. And here's the kicker. It works whether you're 25, 45, or even 55. Stick around because by the end of this video, you'll know exactly which strategy can save your retirement. When Harry finally got serious about retirement at 45, he made the same mistake most people make. He thought he needed to catch up by taking huge risks. He started day trading, buying speculative stocks, chasing the latest crypto trends. In his first year, he lost $8,000 of his precious $50,000. That's when Harry's brother-in-law, a financial advisor, sat him down for a reality check. "Harry, you're not behind because you need higher returns. You're behind because you haven't been consistently investing, and now you're making it worse by gambling instead of investing." His brother-in-law showed Harry something that changed his entire perspective: the power of automatic investing. "Look at this, Harry. If you can invest $1,000 per month for the next 20 years in just one simple fund, you could have over $800,000 by age 65. That's assuming just 7% annual returns, nothing crazy." Harry couldn't believe it. $1,000 a month seemed doable. He was spending more than that on restaurants and random purchases. But here's what really opened Harry's eyes. The fund his brother-in-law recommended required zero skill, zero research, and zero ongoing management. Strategy number 1. The one-decision portfolio. Perfect for beginners. What Harry learned next blew his mind. His brother-in-law pulled up Vanguard's Life Strategy Moderate Growth Fund, VSMGX, on his computer. "Harry, this is what I call a one-decision portfolio. You pick this fund, set up automatic investing, and you're done." Harry stared at the screen. "What do you mean, done?" "This fund automatically maintains a 60% stock, 40% bond allocation. It invests your money across 4 underlying index funds: U.S. stocks, international stocks, U.S. bonds, and international bonds. It rebalances daily. You literally never have to touch it." The numbers were incredible. Expense ratio, just 0.13%. Harry was paying 1.2% in fees with his old broker. 10-year average return, 8.2% annually. Minimum investment, $3,000. Automatic diversification across thousands of stocks and bonds worldwide. "So if I put $1,000 a month into this fund for 20 years, what happens?" Harry asked. His brother-in-law showed him the projection. $491,000 by age 65, assuming 7% returns. Add in Harry's existing $50,000, and he'd have over $650,000. But that wasn't even the best part. "Harry, there are actually 4 life strategy funds with different risk levels. As you get older and want to be more conservative, you just switch funds. No complex rebalancing required." There were even 4 versions, ultra safe to high growth. Harry picked moderate. But here's the trick. As he aged, he could just switch between them. No rebalancing, no spreadsheets, just one click. Income fund, basics. 20% stocks, 80% bonds, ultra conservative. Conservative growth, VSCGX. 40% stocks, 60% bonds, moderate conservative. Moderate growth, VSMGX. 60% stocks, 40% bonds, Harry's choice. Growth fund, VASGX. 80% stocks, 20% bonds, aggressive. Harry realized he could adjust his entire investment strategy just by switching between funds as his life changed. But his brother-in-law wasn't done. "Harry, that's just option 1. Let me show you something even smarter." Strategy number 2. The age-appropriate autopilot. Perfect for set-and-forget investors. "What if I told you there was a fund that automatically becomes more conservative as you age?" his brother-in-law asked. Harry was intrigued. "How does that work?" "They're called target date funds. You pick the fund closest to when you want to retire, and it automatically adjusts your allocation over time. More aggressive when you're young, more conservative as you approach retirement." His brother-in-law showed him Vanguard's Target Retirement 2045 Fund, VTIVX. Perfect for someone Harry's age planning to retire around 65. Right now, this fund is about 83% stocks, 17% bonds because you're still 20 years from retirement, But watch this. He showed Harry how the allocation would change. Age 45, today, 83% stocks, 17% bonds. Age 55, 73% stocks, 27% bonds. Age 65, 50% stocks, 50% bonds. Age 75, 30% stocks, 70% bonds. It's like having a financial advisor automatically managing your portfolio for the next 30 years, Harry realized. The fees were even better, just 0.08% annually. And the fund included everything: U.S. stocks, international stocks, bonds, and even inflation-protected securities. Tips. Harry ran the numbers. $1,000 monthly for 20 years in the 2045 fund could potentially give him $520,000 by retirement, thanks to the higher stock allocation in his early years. But here's what really caught Harry's attention. What happens after 2045? The fund becomes Vanguard Target Retirement Income Fund. It settles into a conservative allocation and stays there. You literally never have to make another investment decision. Harry was sold on the concept, but his brother-in-law had one more strategy to show him. Strategy number 3, the ETF advantage, perfect for tax-conscious investors. Harry, what if you want the same automatic allocation strategy, but with even more flexibility and potentially better tax efficiency? His brother-in-law pulled up BlackRock's iShares Core Allocation ETFs. These work exactly like Vanguard's Life Strategy Funds, but they're ETFs instead of mutual funds. Same concept? Pick your risk level, get automatic diversification and rebalancing. The options were elegant. AOK, conservative. 30% stocks, 70% bonds. AOM, moderate. 40% stocks, 60% bonds. AOR, balanced. 60% stocks, 40% bonds. AOA, aggressive. 80% stocks, 20% bonds. What's the advantage? Harry asked. 3 things. First, no minimum investment. You can start with any amount. Second, you can buy and sell anytime during market hours like a stock. Third, they're slightly more tax efficient in taxable accounts. The fees were still low, around 0.15%, and each fund was built from 7 ETFs. That gave Harry even more diversification, without the stress of picking them himself. Harry realized this might be perfect for his situation. He could start investing immediately without waiting to save up $3,000, and he could use these funds in both his retirement accounts and regular investment accounts. The strategy that changed Harry's life. After considering all 3 options, Harry made a decision that transformed his financial future. He chose strategy number 2, the target date fund approach. Here's exactly what he did. Year 1 to 5, ages 45 to 50. Invested $1,000 monthly in Vanguard Target Retirement 2045 Fund. Set up automatic investing so he never had to think about it. The fund's 83% stock allocation maximized his growth potential. Year 6 to 10, ages 50 to 55, increased contributions to $1,200 monthly as his income grew. The fund automatically shifted to 73% stocks as he got closer to retirement. Never had to make a single investment decision. Year 11 to 15, ages 55 to 60, maxed out his 401k contributions at $22,500 annually, plus catch-up contributions. The fund continued its automatic glide path toward more conservative allocations. Harry was sleeping better knowing his portfolio was professionally managed. Year 16 to 20, ages 60 to 65. The fund reached its target allocation of 50% stocks, 50% bonds. Harry's portfolio had grown to over $850,000. He was ready for retirement with complete confidence. But here's what surprised Harry most: the psychological benefits. I stopped checking my portfolio every day, Harry told me. I stopped worrying about market crashes. I stopped trying to time the market. I just focused on my career and my family, knowing my retirement was being handled automatically. What Harry discovered is what financial experts call the one-fund revolution. Instead of trying to build complex portfolios with dozens of stocks, bonds, and ETFs, smart investors are realizing that one well-designed fund can do everything. Automatic diversification across thousands of investments. Professional rebalancing without any effort from you. Global exposure to capture growth worldwide. Age-appropriate risk management as you approach retirement. ultra-low fees that don't eat your returns, inflation protection through tips and international bonds. But here's the most important benefit. You can actually stick with the strategy. Long-term, most people lose 3 to 4% every year just by panicking. But when Harry switched to one fund, that urge disappeared. He finally slept at night. Which strategy is right for you? Here's how to choose based on your situation. Choose strategy number 1, Life Strategy Funds. If you want complete control over your risk level, you prefer mutual funds over ETFs, you don't mind switching funds as you age, you have at least $3,000 to start, choose strategy number 2, Target Date Funds. If you want true set-and-forget investing, you like the idea of automatic age-appropriate adjustments, you want professional management for life, you're comfortable with the fund's predetermined glide path, choose strategy number 3, Allocation ETFs. If you want to start with any amount of money, you prefer the flexibility of ETFs, you invest in both retirement and taxable accounts, you want slightly broader diversification. Here's Harry's advice after 20 years of success. Pick the strategy you'll actually stick with for decades. All 3 work. The key is consistency. The power of starting today. Whether you're 25, 45, or 55, the most important decision you can make is to start now. Look at these numbers. If you're 25, $500 a month for 40 years, just $1.3 million, assuming 7% returns. If you're 35, $750 a month for 30 years, $765,000. If you're 45, $1,000 a month for 20 years, $520,000. If you're 55, $2,000 a month for 10 years, $276,000. The earlier you start, the less you need to save each month. But even if you're starting late like Harry did, these 3 strategies can still get you to a comfortable retirement. 5 years into retirement, Harry sent me this message. I used to think I needed to become a stock market expert to retire comfortably. Turns out, I just needed to pick one good fund and stick with it. My target retirement fund grew to $1.1 million by the time I retired at 65. I'm living the retirement I never thought possible, and I owe it all to keeping things simple. The choice is yours. You can spend the next 20 years trying to beat the market with complex strategies. Or you can follow Harry's lead and let one fund handle everything while you focus on living your life. 3 strategies. 1 decision. 0 regrets. The best time to start was 20 years ago. The second best time is today.